The same talking points we've heard now for months for Russia, that they don't want to attack anyone, that going into Ukraine is a special operation. This is not a war. It was a preventive move. He also said that now in the territories, quote, that Russia has liberated in Ukraine, they have proof that the United States and Ukraine were working on biological weapons. He reiterated Russia has goals to comply in Ukraine. And then, of course, you have the Ukrainian Foreign Minister, Dmitry Kuleba, saying essentially this was the same old story that we've heard repeatedly. What they want is a surrender from the Ukrainian government, and that is not going to happen. And Jonathan, you have to put your headset and your mind in the perspective of the Ukrainian people. They really feel that this is a war that they can win. There's a huge spirit in the country of continue to fight, and resist. So for the time being, there is nothing that indicates there is a diplomatic breakthrough in sight.
AMH, the pictures that came out of Mariupol yesterday were deeply disturbing, incredibly upsetting, and we're all seeing this play out in real time. There was a conversation in financial markets about so-called peak sanctions. I wonder if the pressure builds even more so, not on the Americans necessarily, but on the Europeans to push further on this, and perhaps the White House pushes them to do so, given that these pictures, right now at least, are a daily occurrence.
Jonathan, that's exactly right. When you see pictures like we have coming out of the city of Mariupol, when we have bombs on a hospital that had a maternity ward, there is pressure now building to really top heights on this administration and capitals in Europe to inflict more pain on President Putin and those that surround him. We already saw a move very early this morning from the United Kingdom going after 7 individuals close to President Putin. Roman Abramovich is one of them, Igor Sechin another one. And then also, Jonathan, here at the White House, we had a Bloomberg story yesterday, a scoop that they're also potentially going to sanction one of Russia's, the biggest atomic energy company. So you can see they are looking at other ways to continue the pressure on the Kremlin in hopes of potentially trying to bring these Russian troops back and stop this onslaught on the Ukrainian people.
Anne-Marie, there's a domestic story here, of course, as well, and we need to talk about it. The Secretary Granholm yesterday faced down oil producers in America and is pleading with them to produce more. We're at a point now where the US government has to think about incentivizing that, given that the price at the moment isn't a big enough incentive for them.
The price at the moment isn't big enough, and a big talking point at the White House is the fact that they have these 9,000 unused leases, but clearly these companies are not using them at the moment. So potentially, Jonathan, that is something that they need to think about. How are we going to get domestic producers to want to engage and drill more? Because obviously taking out Russia's economy, and this is a massive commodity producer across the board, you are going to have elevated prices for a while. But Jonathan, we should note the administration is trying to explain this to the American people, and they are using this tactic, and they are blaming this all on President Vladimir Putin and his war on Russia. We have seen very much so prices spiking because of that. But we should note, in August, the administration was talking about the fact that oil prices were higher and were calling on OPEC. So this has been a problem in the administration, in America, in other European countries as well, in consuming countries. They were all going to be dealing with higher oil prices this year.
AMH, thank you. Anne-Marie in DC. Maria Tadeo, just fantastic work over the last few weeks. We appreciate your time as well. Emily Hill, Luca Paolini, back with us. Emily, I want to come to you. You talk about leaning towards high quality value. Is this just about making it not complicated, keep it simple, maximum uncertainty for the time being at least?
No, we've become much more bearish on 2022. So the reason to be defensive is because, frankly, I think that this geopolitical issue, which we know historically the markets don't react to geopolitical issues, and they in a substantial and prolonged way. But this problem is not going anywhere. We're dealing with a person, and I will confess that I am very surprised that Vladimir Putin made this massive a strategic blunder. I think he underestimated the West. He underestimated democracy, which he's very disdainful of. And I think he knows now that he's made a very substantial mistake, and he's backed into a corner. And so I don't see an end point to this. And unfortunately, when we see spiking oil prices, historically, there is a very strong correlation between spiking oil prices and recessions. I think that correlation has broken down a little bit over the last 15 to 20 years. But the reason to stick with high quality companies with pricing power is that's where you're going to protect portfolios.
We are slowly unplugging one of the biggest commodity producers in the world, on the planet. Companies are pulling back. We potentially could face, Luca, a credit event, a default, a sovereign default. At the same time, we're pulling back QE. It's finished at the Federal Reserve. At the ECB, they're looking to wind that down by Q3. I'm looking at Italian 10-year yields at the moment, Luca, up 20 basis points. Just short of 190, 186. For European banks, UniCredit down another 6 percentage points. SocGen down by 5.5%. Luca, that was such a consensus view coming into 2022 by the banks, by Europe. Things can change for ECB rates. Luca, what do you do with the European banks now, and how much of a risk is building on the continent?
Well, let me say that the call on European banks was based on the assumption that European growth would be very solid. And when you have, inflation, what it is going to be probably close to 7%. You're going to have obviously the impact on confidence, consumer business confidence from the situation in Ukraine. Well, you have on one side the direct impact of Russia, but also the impact of weaker growth. And banks were actually, as you rightly say, very overbought just a few months ago. I still believe that if there is a resolution in Ukraine and Russia, I think European banks have upside, but at this point in time, the risks are simply too high. And so I think we have been reducing our exposure to financials in general. And obviously for Europe, the situation is even more dangerous. And I think you see the price performance. I think it's consistent with the picture that we are seeing. And I think it's difficult to see European banks recovering as long as there is a real risk, not only of a credit event, but also of a recession, I would say. I think it's very difficult to be optimistic in the short term for the sectors.
Oh, the outlook for Europe right now, incredibly difficult, incredibly tough. Luca, great to catch up, sir. Luca Paolini, Emily Hill, thank you to you as well. A difficult outlook right now with the sector price action. Here's Abby.
A difficult day for stock traders, or at least stock bulls, John, because we have the S&P 500 down more than 1%. Not surprisingly, most sectors are lower. Now, what's happening today is a reversal of yesterday and more in line with what we've had for the last several days, weeks. Oil higher, up 2.8%. Energy, the best sector. Then consumer discretionary up fractionally. It had been up higher, more so on that Amazon stock split. The optics of it helping out that stock, but consumer discretionary about flat. You can see tech, though, on bottom. Financials, the second worst. This, as Goldman says that it's going to exit its business in Russia, the first bank to do so. Interesting to see that sector down with yields up slightly. As for the year, John, it's all about metals, mining, and energy. Those are the top sectors on the year.
Energy flying, crude higher again today. Abby, thank you. Up next, your trading diary. 26 minutes into the session, no diplomatic breakthrough between Ukraine and Russia. Equities back down again by 0.8%. The two industry groups that are in positive territory, Energy One for the obvious with Brent and WTI advancing today. Consumer discretionary as well. But Amazon is the story there after that stock split and that $10 billion buyback. That's the price action. Here are your trading diary events. President Biden speaking with President Erdogan of Turkey. EU leaders kicking off a two-day meeting at 11:30 Eastern. The US Treasury selling $20 billion of 30-year notes at 1 p.m. And we hear from the president again later this evening. From New York City, this was the Countdown to the Open.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Thursday, March 10th. Here are the top market stories we are following for you at this hour. A hawkish surprise. The ECB says it may end its asset purchase program in the third quarter, drops the pledge that it will happen shortly before raising rates, ups its inflation forecast, cuts its growth one. Bond yields jump and markets bet on a 25 basis point hike in September. Right on the nose, U.S. CPI comes in exactly in line with estimates. The good news, it could have been hotter. The bad news, it's still another 40-year high. And that was before Russia invaded Ukraine and commodity prices spiked. And Goldman exits Russia. The bank becomes the first major Wall Street player to announce it's pulling out of the country as its war with Ukraine rages on. Meanwhile, talks between the Ukrainian and Russian foreign ministers in Turkey make no tangible progress.
From New York, I'm Kaylee Lyons with Guy Johnson. In Frankfurt today, Alex Steele is off. Welcome to Bloomberg Markets. Guy, it's a big day for geopolitics. It's a bigger day for economics, and especially the ECB front and center right where you're standing.
Absolutely. There was clearly some disagreements in the building behind me. The ECB Governing Council looks quite split. The statement very hawkish, I thought, certainly. And Christine Lagarde tried to push back on this, accelerating the idea that we are going to see an earlier exit from extraordinary monetary policy. She talked about normalization, not tightening. But nevertheless, that's how the markets are priced it, Kaylee. You take a look at what is happening, for instance, in BTPs today. There is clearly now an accelerated expectation that the ECB is going to be tapering and tapering aggressively, then ending policy, and then fairly quickly after that, hiking rates.
Yep, and spreads widening out in quite dramatic fashion today, Guy. And of course, Christine Lagarde reiterating there's still a great deal of uncertainty posed by the ongoing war in Ukraine. Just listen to what she had to say about that in the news conference.
GDP growth has been revised downwards for the near term, owing to the war in Ukraine.
Christine Lagarde speaking a few minutes ago in the building behind me here at the ECB Tower in Frankfurt. Let's get some more insight now into what happened today. Try and get a kind of read on the internals of the ECB right now. Its former chief economist is Peter Praet. He joins us now. Peter, can you decode what happened today? What happened in the press conference? What should we read into that statement?
I think the ECB wanted to give some signal that it cannot neglect, the very worrisome evolution of inflation. So they wanted to give a signal. I personally would not have given that signal by recalibration of the asset purchase program. It's a kind of fine-tuning, you see, where you recalibrate, slightly in a way, but markets took it as a very strong signal, actually. And Christine Lagarde tried to downplay that signal by saying, options are still open. I think it was not needed, actually, what happened today. I think the ECB could have kept, the sort of tapering, which was already understood by the market. By this slight recalibration, I think they created a reaction in the market, which I think was not needed, actually.
Well, and Christine Lagarde pushing back on the idea that this was an acceleration. She said that, in fact, it was not. But in terms of the language that they dropped, dropping the pledge to end APP shortly before raising rates, what do you expect in terms of sequencing and the time frame between those two things?
Well, the sequencing has not been changed. I think that was a good decision by basically saying that when you stop the APP, because that's now in the cards for this year, there should not be necessarily an increase of rates very shortly after. I mean, I could put it this way. And so they have more optionality. I think that was really something which was needed. I think the old formulation in the guidance on rates was actually not good the shortly before. So I think this change is a good change, which increases optionality. I think, as I said before, I think it was not needed to slightly recalibrate, the asset purchase program, because that sent a hawkish signal to the market. While when you think about it, it's really marginal, actually, what you do. And coming with May, June, April, May, June, I think was really not needed. And market took it barely, actually, with a tightening of conditions, actually.
Yeah, we've seen a definite tightening of financial conditions, and Italy right at the center of that, Peter. What does that tell us, therefore, about the debate that is taking place within the Governing Council? Christine Lagarde, the statement talked about that the ECB will do take whatever action is needed to fulfill the mandate. The mandate is inflation. Clearly, there are many on the Governing Council that are worried about that. What do you think is happening in the room? What's going on internally in terms of the debate?
I think there are many different opinions. I think, some of the governors want to, somehow get out of the negative rates, without, an excessive tightening of policy. And so that's one part of the council, trying, to normalize a little bit, what happens on the negative interest rate. Some other governors are indeed more hawkish. They focus on inflation. Inflation figures have been horrible and then have not yet peaked. Christine Lagarde tried to downplay a little bit the figures by first reminding that when you look at 2024, inflation and core inflation remain below 2%, 1.9, which, is, the three conditions for hiking the rates are almost achieved, and there is about 10 basis points below the 2% objective. I think it's a bit messy, actually, when you look at the whole explanation. Why 1.9 in 2024, and why do you need to recalibrate, the APP now? I think, there are many different opinions in the Governing Council. I think this is a little bit, a criticism we could give. We have an extremely severe shock. It's a sort of stagflationary shock. I can understand that the Governing Council has to send a signal that it cares about inflation, but it also has to care about growth.
Well, and
I think, to that
point, Peter, as those inflation forecasts were going up, those growth forecasts were lowered. Is the ECB leaving too much up to fiscal policy with its actions today?
I think fiscal policy is going to be fundamentally changed in the coming years. I think that's a critical change in the environment of the central bank. So as I see it in the coming years, I think monetary policy is going to continue to normalize, but in a context where fiscal policy is going to support the economy. So there will be a very delicate balance in what we call the policy mix between fiscal and monetary. And I think monetary policy will continue on the way of normalization. But my point today is that there was no need to start, giving a signal on the acceleration of, this normalization process. In spite of what Christine Lagarde was saying, this is an acceleration and understood like this by the markets before we know more about fiscal policy later on. So I think it was premature to come with this, in a way, relatively small recalibration, actually.
Peter, and it is, but as you say, it's been amplified by the market. I just want to come back to it. You said that this was not necessary. Why have we found ourselves in this situation? What is, just from a management point of view, is Christine Lagarde in charge of the narrative here? Mario Draghi used to be in charge of the narrative. He would set the narrative and then he would wait for the Governing Council to fall in line. That doesn't feel like it is happening now. It feels like the Governing Council is split, there are clear hawks on it, and Christine Lagarde is having to sort of manage after the fact what is happening here.
Well, it is clear that Christine Lagarde tries to give a fair account of the deliberations in the Governing Council, and there are different views in the Governing Council, and Christine Lagarde tries to communicate that. Now, of course, the downside of this is that when you have different opinions, the message is less clear. It's maybe a fair account of what the Governing Council people think, but the message is less clear. Now, one must admit that the situation is extremely difficult for the ECB. But again, I don't think it was necessary to do that.
How high is the risk of a policy mistake now, Peter?
I wouldn't say that there's a big risk, because the ECB is not going to tolerate, a significant tightening of financing conditions. So they may push back, as they did, unfortunately, in February, because we had already this experience of a tightening after the press conference in February. And then a number of governors, including also Christine Lagarde, pushed back, and then rates went down, the spreads went down. Then we had, of course, the Russian invasion. Now we have this, I wouldn't call it hawkish communication, but I think the signal was taken as hawkish by the market. So that's a reality. And so I think they're going to push back, in the other direction by saying, there are downside risks, substantial downside risks to growth. And so I repeat, I think it was unnecessary.
All right, Peter Pret, thank you so much for sharing some of your reaction to this ECB decision with us. He, of course, is the former chief economist of the ECB. Now, coming up, we'll turn to the other big economic events of today. Another CPI report out of the U.S., another 40-year high for inflation, and it's likely to rise even more. We'll talk with the founder and president of Inflation Insights, Omar Sharif, next. This is Bloomberg.
Big things are happening on Bloomberg in March. First, Bloomberg Triple Take, breaking down the day's biggest stories.
Today's Triple Take focused on the energy transition.
Then, the return of Bloomberg ETF IQ.
The last major holdouts of the ETF revolution.
And the debut of Bloomberg Crypto.
The CEO of Binance weighed in.
Finally, David Rubenstein brings you insights and advice from the world's greatest investors on a new season of Bloomberg Wealth. All this March, right here on Bloomberg.
So it wasn't just the ECB focusing on inflation today. US February inflation data coming out bang in line with economists' expectations. I don't get to say that very often. The prices component coming through 7.9%, Kayleigh. Mike McKee joining us to give us his take, Bloomberg's international and economics and policy correspondent. Mike, we don't often get economists getting it absolutely on the nose. This was in some ways a hot number, but I think the real takeaway from it was that it's going to get hotter.
Oh, yes. And Christine Lagarde today saying that it's the war that's determining the economy in Europe. Same thing here. But remember, it wasn't that long ago that it was COVID, the virus, determining the economy. Put them together and you get this kind of inflation. We've still got inflation hangovers from reopening the economy. And this is February, pre-war. And I'm trying to, use a historical comparison to what we're doing right now. So I put in Leonid Brezhnev. Everybody talks about Ronald Reagan in 1980s. Brezhnev was the head of the USSR. The last time we saw any kind of inflation like this, and just look at this gap here, how high that inflation number is. We haven't experienced something like that in, as Kayleigh said, 40 years. People aren't used to it, and it is going to cause some social, political problems because it's not going to get any better. You take a look at what happened and what went up. Gasoline, 6.6%. You know that when you go to the pump and you see the prices. Here's the problem. This was February. So far in March, since the war began, gasoline prices at the pump are up 19% more. So that's going to be a real thing to watch in the next March CPI report. Food starting to go up as well. This doesn't seem like that much. 4/10 for owner's equivalent rent, basically housing, but it's been like the fourth or fifth month in a row that we have seen 4/10, and it cumulatively adds up. House prices contributing to the problems here. So how does the Fed look at this? Well, they know that a lot of this is war-driven and COVID-driven. They're going to be watching to see if the COVID stuff starts to fade out. And used cars did go down 0.2 this month, but they're going to be watching inflation expectations. Are these high prices going to drive people's view of inflation higher, and will they change their behavior? You can see what happened in the markets today. The markets are pushing up the 1 year to 3 year view of where inflation is going to be. And if that continues, the Fed knows it has a problem. Won't affect this month's Fed decision, but it could affect it in May if the markets decide that the Fed is really behind the curve.
All right, Bloomberg's Michael McKee, great breakdown. Thank you so much. Let's get more on these inflation numbers now. We welcome Omer Sharif, Inflation Insights founder and president. So, Omer, the economists nailed it right in line, but 7.9% is still really, really hot, even if not hotter than expectations. What's the March number going to look like?
So let me sort of try to put that in perspective. We had an 8/10 headline today. If everything in the CPI next month was zero, except for gasoline, you would still be up around 6 or 7 tenths just based off of what gasoline is going to do. So you're probably looking at a headline number next month that's going to be around 1%, if not in excess of 1%. And that's just month over month. And that means the year-over-year rate is probably going to move further up, possibly around 8.3%. But I should caution, today we still got about almost 3 weeks left in the month. So we have to see where gasoline heads. But right now, it looks like we're on track for almost about a 20% increase just in gasoline prices alone in the month.
Omer, the narrative was that the base effects were going to kick in fairly soon, and as a result of which inflation would mechanically start to fall. That looks like it is getting pushed further and further out, and that implies to me that the underlying inflation that we're seeing at the moment is even stronger than actually even the headline number suggests. Is that the correct interpretation?
So Guy, I would actually say when it comes to the base effects, they are starting in April. So really it's going to be with the April, May, and June prints where we really get those base effects starting to flow in. Last year, we printed about 0.8 in that second quarter. So it's going to be very hard to match that. I mean, granted, we have printed about, today was a 0.5. We've been around at 0.5, 0.6 the last 4 or 5 months. But it's going to be tough to meet those 0.8 numbers in the spring. Of course, we kind of have to see what the fallout is from the invasion of Ukraine. But if we don't match those, then mechanically the base effects will really start to kick in Q2. And then you have the story of, what kind of relief, if any, do we get in the second half of the year? And that's really kind of, where we're more focused on is the second half.
Omer, when looking at the different components, you already mentioned gasoline prices obviously could have a big influence in March, but when I look at others just from February, food up 1%, food at home up 1.4%. Obviously, there's the wheat situation when it comes to the bread basket, that is Ukraine and Russia. What specific components are you going to be looking out for, putting gasoline aside?
Unfortunately, it's going back to the good story. Yes, we got some relief on autos today. I think we will get even more relief next month in the auto situation. But essentially, anything that you are transporting via trucking is going to potentially see price increases over the next few months. And that's because as much as we're talking about gasoline, diesel is the other big part of this story because diesel prices are also at a record. 75% of the fleet in the U.S. that's commercial vehicles uses diesel. And so anything that is shipped via trucking, whether it's TVs, furniture, any of those sorts of goods items, you could potentially see fuel surcharges come in to play for delivery. And that means that, if someone's paying more to have it delivered, at the end of the day, that could get passed on to the consumer. So I think we have to go back to the good side of it. And even though it seems like we were potentially going to get some relief, the next few months are going to be very tricky in terms of how that diesel pass-through hits into transportation and what that means for what you're paying at stores for items like TVs and so on.
Omer, let's wrap this conversation up and talk a little bit about second round effects. What are you seeing in terms of the second round effects off these high inflation numbers? I'm standing outside the ECB right now. The Eurozone is not yet experiencing the same sort of wage numbers that we're seeing in the United States. Clearly, wage inflation is a factor right now. Just in terms of how this inflation is changing the US economy, what are you observing?
Yeah, so for right now, wages have been moving higher. That's been, honestly, it's sort of really kind of predated the inflation surge that we've gotten over the last several months. We know wages were going up before. Prices have also been moving higher. But, what I'm really kind of thinking about going forward is what kind of an impact does this have on consumption? Obviously, wages have been moving up, and so people are essentially thinking, look, we should be able to absorb this because incomes are rising. And to some extent, that's true, but real wages have been struggling in part because of this move in energy for the most part. So the question is, does this sort of really hit consumer spending going forward? We already have a Q1 GDP growth figure that looks like it's going to be roughly flat. And even though that's mostly inventories, we've got to sort of focus on domestic demand and say, does this really flow through? I put out a note yesterday pointing out that even though these aren't record prices in terms of, inflation-adjusted data for gasoline, this is sort of the biggest 2-month shock we've had really since Hurricane Katrina in data going back 60 years. So this is definitely going to hit people's wallets. And I really am paying a bit more attention to how does this impact spending moving forward.
Omer, great stuff. Thank you very much indeed, as ever, for your fantastic analysis on what is happening with this inflation story that we're all paying so much attention to. Omer Sharif, Inflation Insights founder and president. Thank you very much indeed. We're going to get back to the Russia story next. The first major Wall Street bank to leave Russia has made that announcement. It is Goldman Sachs. We're going to talk about that next. Sonali Basak is going to be joining us to walk through the implications of this for Goldman Sachs and the rest of Wall Street. That story next. This is Bloomberg.
about that all day yesterday.
Another American business announces it's ending operations in Russia, and this one is a big Wall Street bank, Goldman Sachs. It's the first of the big Wall Street players to do so. Joining us now with more is Bloomberg's Wall Street reporter, Sonali Basak. Okay, so Sonali, they're pulling all their operations out of Russia. What scale and size of operations are we even talking about here?
It's really interesting. For a bank like Goldman, it's very marginal. Goldman only has about 80 employees in Russia, some of which are Russian nationals and some of which we have previously reported are moving to Dubai. And their investment banking operation, underwriting of IPOs and debt, is only about 8th in the league tables for the country, which equates to around $20 million. And all of this is according to my own sources. You know, the interesting thing here is Goldman compared to, for example, Citigroup. Goldman, 80 employees, Citigroup, 3,000 employees. It becomes a lot more difficult to untangle yourselves then, and not just from the country itself, but from the many multinational businesses you do business with that have some exposure to Russian companies or Russian businesses themselves.
So if it may be easier for Goldman to unwind this than others, are we likely to see other big Wall Street banks following Goldman's lead here or no?
Well, I think one major gorilla in the room here is JP Morgan, which of Goldman, Citigroup, and JP Morgan, it has not yet disclosed the size of its positions there, the size of its credit exposure there, and its employee base there. For Citigroup, one thing that's interesting is though they have limited their exposure, they also are trying to sell a consumer business where one of the major buyers would have been a potentially a sanctioned entity such as VTB. So that's the complications in exiting the business itself. Plus, there's another thing that's going on in the background here, Kayleigh, that I think is really important. A lot of these large Russian companies that have relied on these big investment banks to issue debt are now at crosshairs with investors who are really worried about their debt repayments.
Yeah.
So Damian Sassower and I this morning were looking through the CDS exposure, and it is enormous, the risk of default in a lot of these firms.
And that risk is one that seems to be rising. Thank you so much to Bloomberg's Sonali Basak. Great Bloomberg scoop there. A few headlines crossing the Bloomberg terminal that I do want to point out. One, we're hearing from the president about the inflation data we got earlier today. He says inflation number shows the cost of imposing sanctions, but remember this data was before the war in Ukraine even broke out, and we saw the sanctions put on place as a result. He also says it cost on Putin and his cronies much higher than the U.S. Then when it comes to the bond market reaction to that inflation print, the 30-year yield is now at its highest since May 2021 at 2.39%. More on the market reaction next. This is Bloomberg. We're an hour into the U.S. trading session on this CPI day. Bloomberg's Abigail Doolittle is tracking the market moves for us. Abigail, we're lower on equities, but not by as much as we were earlier.
We are off the lows, although we're down 0.9% after yesterday's big rally. And it's interesting, Kelly, because you and I were just talking about oil. What happened to oil? Not so long ago, oil was up 4, 5, 6%. Now it's up just 1%. We're not aware of any headlines influencing this, but as we've been talking about over the last couple of days, technically oil is very overextended, so it's not surprising to see it continue to perhaps come off of its highs. As we see here, though, a big story in the week bonds. This is pretty incredible. The 10-year yield backing up more than 25 basis on the week, sort of hidden to some degree by all of the action in stocks and commodities. But this is critical, of course, after that CPI print, the highest in 40 years, a fresh 40-year high, plus the Fed next week. As for some of the movers beneath the surface for the S&P 500, Goldman Sachs is down, similar to other banks, even with yields higher. And of course, Goldman is exiting its Russia business, as Kelly, Guy, and Sonali were just talking about. Apple down 2.9%, a real weight. Amazon, on the other hand, higher on that 20-for-1 stock split. The optics better for retail investors and traders. Perhaps the $10 billion buyback. And then ExxonMobil up 2.3% as oil tries to hang on to its gains. As for the S&P 500, one reason to think that yesterday's start of a relief rally could continue. We have a bullish divergence here for the S&P 500. This is not a long-term bounce, but a near-term bounce that could actually be pretty difficult to play. It would be probably present more of a sell the rip opportunity. On the bottom, we have the RSI. You can see it's in this coil coming up in a series of higher lows, suggesting momentum may go to the upside. This as the S&P 500 is going down. It points to the idea that you could see the bullish momentum bring the S&P 500 back toward that 200-day moving average, Guy, right around, I believe, 44.67 or even higher, 4,500, 4,600. But again, probably a near-term pop if it happens.
Volatile markets. Abigail, thank you very much indeed. Let's talk more now about that volatility and figure out how exactly you should position for it. Sarah Hunt, Alpine Woods Portfolio Manager, joining us now. Sarah, central banks, the central bankers here at the ECB, where I am today, certainly struggling to plot a course through all this macroeconomic volatility. What are you doing at Alpine Woods? How are you plotting a course through it?
Well, as I said earlier in the break, I think that we were positioned already for trouble with central banks because you knew that the Fed was going to have to raise rates. You could see the inflation coming even before the Russia-Ukraine conflict. Unfortunately, besides from the horrible humanitarian toll, you've added to the problems that the central banks are facing because they are also looking at now higher energy prices, higher food prices, and a potentially protracted problem that seems very difficult to fix. You can see the markets reacting to any hope that diplomacy will find some sort of solution where clearly it did not. So I think that this is really just something that makes a very difficult situation worse. And I think that you're looking at higher commodity prices, higher food prices, higher input costs. That's difficult for central banks and for equity markets.
So when we think about the equity market, as you say, it's reacting to each and every headline. Yesterday, the best day since 2020, which was only 2 days after we had the worst day since 2020. Would you be a buyer of any dips here, or is it too early to find a re-entry point given the uncertainty out here?
Well, you've seen a lot of sector rotation. So some of the sectors get to the point where you think, okay, you're starting to see some valuations that look reasonable. The industrial sector, which ran early, has come off quite a bit. And so I think that there's some opportunity there in the industrial sector. Some of the very high-flying stocks with very high valuations have also come off a little bit. I think it might be too early for some of them. We're certainly looking at some of that. But if you think of things like cybersecurity, that's only going to the need for that is only going to get worse as we move along. And I think that some of those areas you might see some opportunity. I think it's difficult, though, as you see the markets whipsaw back and forth, to be careful about entry points. And I think that that is the toughest thing to deal with right now, because after a long period of no volatility, we've got so much volatility. And just as you were mentioning earlier in the bond markets, that bond market volatility is very high, too. So it's a very different environment than we've been in for the last several years.
Okay, let's talk about entry points and let's talk about the energy and commodity sector, Sarah. It has done incredibly well thus far this year, but we've seen some real volatility there in energy prices over the last few days as well. If there was, and this would be fantastic, some sort of a ceasefire, I'm assuming energy prices would come down relatively quickly. Is it too late to put fresh money to work in commodities?
Well, I think that energy prices would come down quickly. The question is, what level would they come down to? And I'm not sure that they're going to come down to a level that gives a lot of freedom from lower gas prices and from lower energy prices in general. You already had rising energy prices before this happened, and a good deal of that is because demand got a lot better and the supply situation hasn't changed very much. That's partially due to the issue of trying to transition away from fossil fuels, but that's a very long tail, and I think that the curtailment of supply even before this happened was showing you higher energy prices. So I think that there are ways to, I think that there is an ability to get into some of these energy stocks, because I think you're going to have a longer period of time where energy prices are going to be elevated from the expectations a few months ago. Not to the extent that they are right now if you get some sort of solution, but I think you're still going to have a higher longer-term energy price for the next 12 to 18 months than people were expecting even 6 months ago.
Obviously, Sarah, energy, a classic cyclical, also value play, though it has gotten more expensive. In terms of what else is expensive, obviously there was a narrative that you wanted to shift out of growth this year. Is growth an area you might want to be getting back into, given valuations have come down, and do they present some kind of defensive opportunity?
Well, it's interesting because last year there was a lot of discussion about tech stocks and whether or not they were defensive or they were growth stocks. And I think there's a combination there. I think that there are plenty of technology stocks that have a growth aspect that are also fairly defensive and have reasonable valuations. And I think that's what people are going to be looking for going forward. I think we're questioning whether the earnings on the PE ratio, we even know what they're going to look like this year because the input prices are moving so quickly. But I think that there are a lot of those technology stalwarts that sort of got sold off in this that still look like they're not unreasonably priced. I mean, even some of the big ones, forget Amazon with its current stock split, but even Google, it popped up on earnings, but then it came back. I think that there are places in those larger tech names that you can find some value here and that you can enter into. But I think it is going to be a very unusual year because we just don't know so much of the input side.
All right, Sarah Hunt of Alpine Woods, we have to leave it there, but thank you so much for joining us. Now, coming up, we'll get back to one of the forces driving input costs higher, the war in Ukraine, putting the shipping industry's recovery in jeopardy. We'll talk with the CEO of Hapag-Lloyd, Rolf Haben Jansen, next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The House has sent a signal that both parties want stronger punishment of Russia for the invasion of Ukraine. By an overwhelming majority, lawmakers approved legislation barring U.S. imports of Russian oil. The vote came a day after President Biden used an executive order to ban Russian crude imports. It's not clear if the Senate will take up the bill. The UK has added 7 more prominent Russians to its sanctions list, including the owner of Chelsea Football Club, Roman Abramovich. They face a full asset freeze and a travel ban, plus they are prohibited from doing business with UK citizens or businesses. The move effectively derails Abramovich's plan to sell Chelsea. And the war in Ukraine has the shipping industry braced for new shocks to its labor force. Ukrainian and Russian sailors make up nearly 15% of the industry's 1.9 million seafarers. They also make a high proportion of its officers and ranked crew. Now, many of them can't get to their ships, and those on board can't get home. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, the latest attempt at diplomacy in the war in Ukraine appears to have gone nowhere. The foreign ministers of the two countries met in Turkey in their first discussion since the war began, and Ukraine's foreign minister said Russia indicated it would continue attacks until its demands are met. Meanwhile, President Biden discussed the war in a call today with Turkey's President Erdogan. Joining us now for more on all of it is Bloomberg's Anne-Marie Hordern, who is in Washington at the White House for us. Anne-Marie, the Biden administration clearly has already ratcheted up its moves here. We have seen the action on energy. Now we understand it may be sanctioning a nuclear power player when it comes that operates within Russia and actually has a lot of business related to Europe as well. What does it do next with no sign that diplomacy is going to make progress anytime soon?
Well, I believe, Kaylee, you outlined it there. They're just going to continue looking at ways to sanction the economy because it is hurting the Russian economy. All of these sanctions from the West, the United States, Canada, United Kingdom, Europe, Japan, all of this is starting to cripple the Russian economy. The stock market has yet to open.